Everyone, welcome back. To end out the first day, we thought we'd finish on a strong note with Ross, and he's going to be talking about how to manage risk and position size to maximize performance. And obviously, you know him as the head trader over at traderline.com, but he actually got to start back in 1995 at Oldie Discount Brokerage before later transitioning over to William O'Neill and Company in 1998 in the institutional sales department. And then he became a portfolio manager and worked closely with Bill in 1999 through 2003. Later, he moved to New York and started a hedge fund in 2004 to 2009. And finally, he founded Traderline in 2017. So with that said, the floor is yours, Ross, and looking forward to your presentation.
All right, Abe. Thank you for that very kind introduction. Before we get started today, just want to give everyone a brief glance at our agenda. Here's what we're going to be discussing today throughout the course of the presentation. So let's start right at the top. Why is risk management so important? Right off the bat, without sound rules in place that guide you in terms of stop losses, position sizing, an understanding of the life cycle of a stock, where you're betting the heaviest, where you're trying to take some money off the table, so to speak. That is all going to be in your risk management rules. The bottom line is this: I could give you 50 perfect stock picks in a row, and the likelihood, if I gave all of those picks to a room full of traders, the majority of people are going to lose money. And for one reason or another, it's going to come down to either a lack of risk management or position sizing wrong. That is not 9 times out of 10. It's one of two of those, if not a combination of both. So that's what we're going to discuss today. It's not as exciting as looking at big leading charts, which definitely tends to be more fun, but this is a very important part of the market. And you'll see we'll discuss a little bit of the emotional factors that play a part as well, which is also a big deal. The bottom line is this: you can be right on your stock selection as little as 3 times out of 10 and still make a fortune in the market, as long as you're cutting your losses quickly. When you're wrong, that in and of itself, it should be reason enough to get this part of the equation down. Anyway, enough said. As we can see here, picture is worth 1,000 words. Very simply, we can see why. Well, there's a couple reasons why that 7 to 8% winds up being the max sell stop you want to have on any one given trade. And you can see here a loss of 7.5%. You don't need to make much more back than you lost. Once you start, getting outside of that 7% range, it becomes much harder to make your money back. Most people struggle to make 12 to 15% on a stock, on a trade a year. So once you start having to recover 25 to 50% of your capital, you're heading well in the wrong direction. So that's one big reason you want to keep those losses tight. We're going to see on the next screen, this gives you the picture a lot more clearly. So you're able to be wrong 7 to 8%, 2-3 times in a row. And as long as you're right one of those times, for, let's say, what would be the average gain on a breakout of one stock, 20 to 25% from the breakout to the time it consolidates and builds its next base. You can see how the numbers add up. Once you start losing 10, 15% or more, not only does it dig into your financial capital in a hurry, it really starts to eat you up inside and affect how you're thinking and the way you trade. And Bill used to tell us all the time, the market doesn't care what you think or how you feel, which is why you have to have rules, right? And so the rules all come down to managing risk, managing your position. Yes, there are some for stock selection, but the rules that are going to save your butt and really help you make the big gains and stay consistent over time are the ones that cover risk management. Where you're getting the heaviest in the market, where you might want to take some off, where you want to be careful, that whole sort of thing. There are times that we're going to sit in cash, at least in the way that I trade. I'm very much a position trader more than anything else. So I will tend to be very long or in cash. I don't do a whole lot of shorting. In a powerful bull market, I will, trade extra stock around my core positions in the stocks that I'm already long typically. So anyway, enough going on there. We can see why, keeping your losses super tight is extremely important. So for starters, we know that a market can either move up, down, or sideways, right? So as a position trader following William O'Neill's CAN-SLIM methodology, my goal is to only participate when the market is in an uptrend or when we're in a bull market. To me, that's when the deck is hot, so to speak. So like players of blackjack, and I'll mention it a little bit later on, in the movie 21, if you've seen it, you've either got a hot deck. There are, depending on how it plays out, there are various, you can be very hot or going cold, but at some point there's a very specific line where no more bets are placed on the table. And that works very much the same way in the stock market and getting down. These are the rules that you need to get down. Some of them are very much like, the card counters in that play blackjack. They're quantitative. The numbers are this. It's very black and white. What doesn't exist in blackjack is the qualitative factors. The cards are the cards, whereas stocks have personalities. You've got all the different players in the game, supply, demand. There's significantly more factors affecting the market for starters, and a lot of them simply can't be quantified like the game of blackjack can. So it's comparable, on a big picture basis, but larger picture, the market is much more complex. However, maybe I'm biased, but I want to say that I feel like I probably have a better grasp of controlling risk than the guys who are sitting in the casino counting cards, even though, their rules are very black and white for them to reach their goals over time. On the qualitative side, one of the things I keep very closely focused on is market rotation, or rotation through the leaders, and specifically the sectors and industry groups. I want to always make sure that the groups and sectors that are leading the market higher are first of all, your typical growth groups. If you're seeing utilities, food, stocks that are defensive in nature, lead the way, metals, mining, oil, that sort of thing. That's not really what I'm looking for. I want to be sure that I'm seeing rotation within groups of specialty retail, medical, which, medical supplies, medical services, healthcare, which is a ton of stocks. The genetics and biotechs are a huge group in and of themselves. The biotech group, I think, is close to 700 stocks. There's oftentimes you can see rotation within that group alone. On the technology side, I don't need to name all of the different industry groups and sectors in there, from chips to you name it, chips to internet to all the cool things you could, what you want to get your hands on, right? So that's one of the main things. So while I'm doing that, I'm also keeping track. So while I'm watching one group get extended, let's say, I'm watching what other groups that I consider high growth, high quality groups that are typical of sustainable bull market trends. And I keep I'm keeping constant alerts on these stocks. I'm watching how they're forming their bases. I want to see, are they ultimately building a constructive base? Does it look like they're under accumulation up the right side of a new base? Might we see rotation out of these extended names as, they get tired and over here? So I'm always trying to know ahead of time what group might catch the rotation. And if I start to see oil and gold shape up, and, stocks that have been on big runs start getting hit and money, going into I don't want to see a flight to quality and defensive names. I want to make sure it's always going into the real growth groups. And when I'm looking at those stocks that are setting up here, another thing you also want to be very aware of the market's life cycle. How far are you from your follow through day, and where are those stocks? Are those stocks, are they obvious now? Or are they on their, have they had built 3 and 4, bases and had been big runs already? So you want to make sure that you're not looking for rotation into a group that's got, a majority of stage 3 and 4 bases, and the ones that are lower down are your laggards. That you don't want to get stuck in that game either and say, oh, well, these haven't broken yet. They haven't broken out yet for a reason. That's why they're down there. So all of those things are, you want to have rules around those things, and that's what's going to keep your performance high, your losses to a minimum, and keep you in the game really with some big performance over time. It's having not only having the rules, but developing the discipline to trust them and actually follow them. That makes a huge difference, right? So let's talk about managing risk in different market conditions. Remember, I think I was just mentioning before, blackjack. This is where I like to talk about, the movie 21. I'm not going to go over it again, but in general, we see this chart to the right. There are periods where you've got sharp up moves, but in general, that's a very, choppy overall environment. It was very easy to get chopped up over that period of time. And so having rules that either keep you out of the way or keep your losses to a minimum are super important. That's the bottom line here, right? You want to be like, just like counting cards, when the deck is hot and getting hotter, you want to have all your money on the table at that, at the beginning, at the hottest point, when the money's flowing in, it's early stage bases. We've all been there, for those of us that, have been doing it for a while, where there's so many leaders working, you simply don't have enough money to buy them all, right? So we all know that feeling. That's when, that's the hot deck, when everything's breaking out. That's when you really want to take the most risk. And as the rally ages and stocks, get up in their moves, building 3rd and 4th stage bases, that's the time to start looking for distribution and being careful and keeping in mind the average stock is going to start to struggle around stage 3, stage 4. So what are you going to do around, obviously you want to be very careful pyramiding up there. If you do, you want it to, right, you're going to use different size, different stops than you would possibly, earlier in the stock's overall life. So now let's get here. I think I've kind of hammered that point home. As far as initial position sizes, how should you start? Well, I would just say this. So let's say for a smaller account, $10,000 to $20,000, Bill will tell you, you don't want to get too spread out in there. Maybe you want 3 to 5 stocks, whereas, as the equity grows, then maybe, you can spread it out to 5, 8, 10 stocks. Everyone's going to, everyone's going to be different. Bill's very comfortable putting 200% of his money in one stock and letting it sit there. I typically have been comfortable with 3 to 5 stocks. However, with the latest volatility, I'm having more success probably with that 6 to 8 mark. Now, you can add to that, do you use margin? Do you not use margin? So there's going to be a million ways you might split this up. And one of us might be comfortable starting with only 10% of our total money in the market. Someone else might think that's way too little. I've got to have at least 25 or 30%. There's no right answer. There's only what's right for you. You've got, Bill's, I'll tell you a lot about Bill, his big thing of sell down to the sleeping point. You shouldn't be losing sleep. You can't be sitting with anxiety in your heart over what if you have that going on, you've got too much invested, and you don't worry about the guy next to you. If you're only comfortable with 3 to 5%, then that, to get started until you develop a little bit of cushion and give yourself some confidence. There's nothing wrong with that. As a matter of fact, that's going to be your anytime, and we all get in ruts, anytime you get in a rut, that's going to be the best thing you can do, is to immediately scale back to that tiny little size and force yourself to make, baby steps. You'd be surprised how fast you gain your confidence back and the size grows all by itself. Let's move on to stop losses, which, when we're talking about risk management and managing our positions, this is going to be your number one thing. You remember at the beginning of the presentation, it's all about quick losses. As long as you are following a sound system and your losses are tight and logical over time, if you are, using a system like CanSlim where, everything is very specific, as long as you are following that discipline where your rules keep you in the game and keep you ahead, making profits and protecting you on the downside, you're in great shape. It doesn't matter whether you use CanSlim or your great uncle who used to be a specialist on the floor taught you. It doesn't matter how you skin the cat at the end. I promise you, nobody is doing this without using stop losses. Otherwise, at one point or another, you're going to wind up upside down in a big way, and very often out of business. So what we've got here, over to the right, I've just a simple example. These would be considered regular textbook CanSlim base breakouts where you buy through the pivot on big volume. Now, again, remember in the beginning, we were discussing 7 to 8% just as a ways of keeping you from getting too out of control. And that's a great magic number in that respect. But also the 7 to 8% that Bill came up with is not only for that reason. So remember, he studied every market cycle going back to the beginning, basically, and figured out the most common characteristics of the biggest winning stocks. So to keep it very simple, if you keep your universe to those stocks that only meet the CanSlim characteristics, and you're disciplined to only buy them when they are, following those rules, breaking out of a big base on a huge increase in volume, the majority of the time, those stocks will not fall back 7 to 8%, right? So that's why you want to, when you have that early textbook breakout, and you really want to give it that room. If you need it. In this case, you'll look here, Google ultimately picks up support at its 21, 23 day moving averages, simple exponential, whichever one you use. Some people use a 20 exponential or a 20 simple and a 21 exponential. I like to use a 21 day simple and a 23 day exponential. Regardless, the stock picks up again, and it's like a liquid leader will do with solid institutional sponsorship. It never gets even close to that 7 or 8%. It ultimately finds support at a prior, let's say, early pivot. That's where you could have snuck in early. So not only are you getting, you've got a confluence, right? A prior pivot area, as well as your 21 day and 23 day exponential moving averages there. And sure enough, you get support there and the stock moves right back out again. So just, again, having those rules, knowing those statistics, knowing that you have, that's a lot of power, understanding that you can just leave that alone, and you were blessed here and didn't have to suffer probably, maybe you're only 3, 4, 5% there before it ultimately recovers and blasts and gaps up, blasts off. Sure enough, we tighten up, move back into the averages, and here again you can buy the stock 7 to 8% stop loss. I would tell you don't really want to buy more than 2% past that pivot to really give yourself the benefit of that number, that leeway, that full stop loss. But in this case, you see it just you never even need it. It just takes off, and you can see it it continues to respect the moving averages, so on and so forth. So that is that's your basic textbook sell stop, your max sell stops on, a big volume breakout. It doesn't matter if it's from a cup and handle, a double bottom, or as long as it's breaking out, breaking out of an early stage base, the stocks meet those CanSlim characteristics, you can rely on, those statistics. And so there's the beauty of that there. And you'll see as we move forward, a lot of times these, and it's another reason you want to focus on the leaders. The leaders will typically be liquid, have that solid institutional sponsorship, which is why they'll, stocks with choppier earnings, less sponsorship won't tend to respect these moving averages and pivots as much. So that makes things much, it's just another benefit of, trafficking in these names. It oftentimes it keeps you away from even having to deal with stops on the maximum side of 7 to 8%. Typically you can keep them to 3 to 5%. And if you talk to just about anyone out there, whether it be myself, Ray, my buddy Mike Webster, that we're all trying to keep it to 3 to 5% if we can. In these cases where we're going to let our odds, the odds play out for us. We're not going to cut something short if we don't have to. But in general, that's what we're looking to do. And again, if you're staying in these high quality liquid stocks that have high quality, institutional sponsorship, it's going to be much easier handling these stocks and holding on to them and dealing with stocks, because they tend to stop in more logical, organized, easier places than some of these thinner, let's say, biotech stocks. Those things will give you a big headache. And it's not just the biotechs. I mean, you can look, this chart here that we're going to look at shortly here is Ford. This one trades relatively tight. So, there are other ones that whip back and forth that, there's no, that characteristic is not saved for any one industry group. You just got to take a look at the stock you're looking at. If it's got wide ranges, it's got wide ranges, and it's time to be careful, especially if those ranges can be 12 or 15%. That's something to keep in mind. So anyway, Ford here, and you can see this is a recent breakout. This worked really well. I just wanted to show again, you've got this powerful, big volume breakout. You can use, this is the spot where you would use that textbook 7 to 8% based on Bill's research and the fact that you really don't want your losses to get out of too far past 7 or 8%, or what you have to make to get back to even becomes close to unattainable, especially as your psychology and your brain, the way it's very easy to get negative. We'll just leave it there. So that what we just got done discussing was your textbook breakout from your typical base breakout. What we're looking at here is something that that we do with TraderLion, that I do in my newsletter. This is actually the entry areas from my newsletter as it stands. So it just turned out to be a good example. These are early up the right side. So taking a look at Ford, you can see you could have bought the Bill O'Neill textbook breakout and employed the 7 or 8% as we discussed prior, or like I tend to. My goal very simply is to try and get into a stock early. Okay, I want to be pyramiding the end of my position, or maybe adding on a little extra, to sell when it gets extended and bring down my average. If the volume is huge, but I like to be polishing off my position at the dead latest at that breakout. It just so happens you have the least resistance there. We know the study, you've got 7 to 8%. When you're coming up the right side early here, you've still got resistance there. Your probabilities are less. That's the reason we wait for a base to fully develop and try it. Textbook, we really don't want, we don't really want to be buying much more than 15% off highs, give or take, depending on a stock's personality. So when you're buying in the lower third of the base, you want to use tighter stops. Now, remember, those stops still have to be logical. In any event, Ford gives you that ability here to buy, super liquid stock. You can sneak in early in both of these places. Which moving averages are you going to use? Well, it's simple. I just start looking to the left, and I can see here Ford shows a clear respect for its 10-day simple and 23-day exponential moving average. And if I continue to look back, you can, on a longer chart, you'll see that those two averages, it tends to have a large respect for. So when I'm buying up early here, I'm going to be using, those are the two averages I'm going to be focusing on. And depending on how Ford plays out, maybe I'm going to sell half below the 10, half below the 23. Maybe if it really starts to fall apart, I'm going to sell all of it below the 10 because I'd rather keep the loss super tight and try and buy it back again. That, it just, it depends on, it just depends on the stock, how it plays out, where I own it already, so on and so forth. So that's, I mean, there's really nothing special here when you're buying up early because you've got more resistance, you've got lower probabilities. You want to keep your stops tighter. Let's say max 3 to 5%, 5% max if you can. Let's say 2 to 4%, and those are typically going to be 9 times out of 10. I will look for the shorter term moving averages to use for a sell stop. If one of those don't make sense, and sometimes they don't, then I'm going to look back in the stocks pattern for a key high, a key price point or level that I can use that's logical and tight, whether it be the low from the prior day, the high of that, base going over to the left, whatever it may be that makes sense, that's tight, that would provide support. That's what I'm going to use. So that's pretty simple in and of itself, and we get this question a lot. It's actually very, quite simple as the picture, looking at the chart helps you a lot, so as you're working your way into a stock, how do you move up your stops? What's the process around doing that? So here we're looking at a snapshot of NIO in the very beginning. Yes, the price is a little bit low here. The reason that there was no reason you had to start buying when the stock was $5, but there was a lot of people who did. And in this particular case, NIO had it was in, Tesla was the big leader of 2020. NIO was probably the second or third strongest stock in that group. So based on that, remember I said how the group thing is extremely important. So just because of its relative strength and the strength of that group, I'm immediately going to look there. And it just so happens that it happened to be very liquid at $5 and have a good amount of institutional sponsorship. So this is one of those rare cases where, $5 is typically, I'm going to tell you, a penny stock. I won't even look at it, but because my eyes were on this one, because, when I look at Tesla and I put up on the weekly chart and I'm looking at the top 5 relative strength stocks in that group and NIO's constantly up there, I need to take a look at it. And so if just in case anyone is wondering why we're looking at a $5 stock, that's why we're looking at the NIO $5 base. In any event, it turned out to be a good example of what we're discussing here. So let's take a look, and I would also start I'd also start by saying this: when you're buying a stock, it's never an all or none decision. It's never all or none on the way out either. You can sell it in pieces, thirds, quarters, halves, whatever fraction your brain likes and makes you happy, however fast or slow, big or small. There's no right or wrong. Listen, if it makes you happy to have one spot and knock out the whole position, there's nothing wrong with that either. It's just got to work for you. You constantly want to be looking back. If something's not working, you need to be assessing what's wrong, figuring it out and changing it. I mean, that's a given, so bearing that in mind, here we've got marked, we're going to start, and this is early up the base. We're going to start 1/3 of a position there. And this is just an example. So let's say we wanted to buy 1,000 shares. We're going to buy 333 shares right here. We're going to use stops at its 10-day moving average. We can't see to the left, but in any event, that, since we're buying early up, it's a consolidation pivot or early entry here. We're not giving it a full 7 or 8%. Sure enough, the stock breaks out, quickly fails the following day or two later, but that 10-day moving average keeps us in. The stock eventually recovers. You could buy it again there, and sure enough, it gaps up, completing the right side of the base. That's a huge, powerful move. So maybe you've bought your first, third, and second, third position here. Maybe you've only bought 1/3 here, and as the stock, it's not the ideal situation. I'd rather not be buying the majority, 2/3 of my position, but it happens. I mean, there's times where I have to buy a whole position, as it's breaking out of the base, and sometimes I can't, it's tough. Is it too fast up the right side, so on and so forth. But in any event, whether you're buying your last third or your last 2/3 here, now, believe it or not, because of all of this power, you're at a full, you're at your full base breakout. You're through most of the resistance. From this point, you can use, your max 7 to 8% sell stop. And as you're buying this stock, obviously, you no longer need to keep a super tight stop on this one because you're up and out of the way. So that's what, oops, sorry there. This is when you want to raise your sell stops as you're up at this point on your prior two buys. You want to change, you would want to raise these to the 23-day moving average. And then, then you're free to give this trade 7 to 8%. Obviously, you want to see how that's good, how much you're adding and how much a max loss there is going to affect anything you bought prior. I mean, it's got to make sense. You can't let it swing 7 or 8% and turn your entire trade upside down. If that's the case, you need to change that. I mean, in any chance, if you're up this much on a stock, you have no right letting that turn negative on you. I'll just leave it there. And when I'm adding to a position, I typically like to keep ultimately, this is going to all be one trade out of this base. But as I'm building the position, I'm going to keep a different sell stop on this piece than this piece. And then at some point, as I move up here, I'm going to have an average price on this whole breakout from this point, and I'm going to start moving my stops and playing them according to that. So, as you make progress here, and there's little spots that you could have added and continued, and you can see using that 10-day moving average works like a champ all the way, it gaps up and takes off, follows that 10-day moving average the entire time. So even if you were aggressive and added at these spots following that 10-day moving average, and remember, we do this on stops are to be followed. There's one very specific occasion where this isn't the case, and I should have said this earlier, sell stop should be followed on a closing basis. The reason that is when, remember, we're only investing in powerful bull markets. In a bull market, bull market action is weak in the beginning of the day and a strong finish. Sometimes you can be ugly until the last 5 or 7 minutes of the day, maybe not the whole market, but certain stocks. And if you don't give it till the end of the day, you'll wind up getting shaken out unnecessarily, not just a few times, quite a few times. I would say this, there are some people that want to do it intraday. I would just say that if you're going to do whatever you do intraday or on a closing basis, keep it consistent. Don't start mixing that up. Otherwise you can't keep track of what's going on. So I always like to, now listen, if it's a stock that I just bought and it's, falling outside of that 8% after, the breakout fails, I'm not waiting till the close. I mean, my max is 8%. That's 8%. The breakout failed. I'd rather not have to buy it back 8% higher, but you know what? That is your worst case scenario. And that's way better than being down 20 or 30% the next day for whatever reason, right? The reason it failed like that is because you didn't know there was an offering that, was coming, and then so, there's these sell stops for a reason. So in that case, you don't want to let a max stop get you out of control. And there's also another situation. So there's two, when you're using moving averages to force you out of a winning trade towards the end of that trade, there is another particular spot where you will want to stop yourself out on an intraday basis and not wait till the end of the day. So you can mix this up any way possible. Again, let's say the market just followed through. Tesla's ripping, you expect big money from this when the volume starts to come in. Maybe you put on your whole position or 2/3 of a position here. Oops, sorry about that. And, add less on the way up or not add at all, or wind up doing. So there's so many ways you can do it depending on your style, or, if you woke up late and you missed one area, and you're sometimes, that happens, and you're forced to catch another area, and you're playing it off the 10-day, and hey, it's your lucky stock, because that 10 days is going to keep you in for a huge move until we base build again. And then it's the same process all over again, right? So what stage base is this? We don't remember, as we're getting towards third, fourth, fifth stages, the likelihood of failure increases. But assuming this is, let's say this was first stage, this is second stage, you play that same game again here. I drew the lines at potential pivots early along the way. You could start anywhere from this line, on any of these 2 days, using these 3 lines on your way in. How you break that up and work your way in is up to you. But the idea when you're buying early up the base is to try and use one of these short-term moving averages to keep you, tight and out of trouble. And then once you've got the real breakout, your textbook breakout there, and it's an early stage base and everything is copacetic, if you want to loosen up your stops from that point, you can do so, at least on that piece, right? A lot of times it's going to wind up, the idea is for it to all get, but anyway, as you start doing this, and start looking at this thing, at these chart after chart, and it's going to all click in your brain, and you're going to draw a few lines, and you're going to, in a glance, you're going to have an idea of how you're going to work your way into a stock and set your stops. It becomes a fairly automatic process after, you get your rules down and draw enough lines and figure it out enough times. It just kind of, like I always tell everyone, for me, I think a lot of it snapped when I was working on that model book with Mike and Charles for Bill, when I was, at the firm in, 99, 2000, I was very lucky to be there during that time to, 98 through 2000. So we made the model book for that period, and a lot of things snapped, like, why aren't we buying a little earlier, and, how to tighten up sell stops, keeping them tighter yet still logical, and not, adding to your performance, minimizing a little more risk, that sort of thing, just kind of beefing it up a little bit from my perspective. So here are some guidelines and rules for how to position size properly. If you're looking for a place to start and ultimately create your own personal rule set, this is here for you to reference. Here's a zoomed out view of NEO. I know we had the zoomed in view of this area here. And you can see the stock works like a champ. And you can see as we get later, the stock ultimately holds its 23-day exponential moving average throughout the entire length of its run. So this makes it very easy. And this is another, we'll discuss this. And this is my style of trading, really, unless I have a very obvious climax move very late in a run. It's screaming climax. I tend to let my stocks push me out. So this is going to be one that, when it says it loves its 23-day exponential moving average that much, when we get a close below, I'm going to sell at least half, and then, possibly give its 50 and or 65 day a chance to hold up the stock, depending on where it is, where I am. But so again, you depending on where you own it and your personality, your style, you might just choose to sell the whole thing below the 23-day, because the 50 days another 7% lower, and the likelihood of it going there is good now that it's below the 23. There's no right or wrong. Maybe you want to give it to the 50-day and try and buy back the half you sold below the 23, and now you risk, losing that much more if you're wrong and it continues to break below the 50. This late in the move, buying 50-day pullbacks are, you typically want to buy those your first two after a stock's initial breakout, not, once you're later in the base, or once you are much later in the move and a stock started to break down through the averages it was holding throughout the length of its run. Probably not the best time to play the moving average bounce trade. So in this case, if you wanted to get, very specific, I'd probably get rid of all of it below the 23-day, just because the 50 and 65 are a good chunk lower. And I'd rather sell the whole thing, see, and if it's gonna bounce, I'd rather let it show me a bottom and risk having to buy it back higher than, wind up selling it down here, because I got stubborn or whatever it was, my emotions. And that's typically what it is. Remember, market doesn't care what you think or how you feel. Bill told me that all the time. So, and it doesn't know who you are, doesn't care. So that rules are all you need. So anyway, we've looked at NEO long enough. Here's an example of a stock that ultimately fails. Horizon Therapeutics had one of the few more liquid names with decent sponsorship and big quarterly earnings growth. So here we approach the stock in the same way. We can buy first third of a position here. Doesn't really follow through and break out. In this particular case, now, this is a little early up the right side. This is not a proper base. So that's why we're not at 7 or 8%. And I wrote 10, 10 and 23 day. That's the focus. Why? Look to the left, 10 and 23 day. I'm sorry about that. The 10 and 23 day moving average gets respect from this stock. So because we're a little bit early up the right side, ensure the 10-day moving average holds us for this first pullback. Now you're adding your second third. And you don't even get to finish the stock off, right? It basically sells off for a couple more days, breaks below its 10-day moving average, which now you're in an immediate loss. So the breakout's not really working. You're breaking below its 10-day. You want to sell at least half your position there, maybe all of it, depends on how tight you like to keep things. If not, you can hang on and see what happens. Ultimately, you're forced out of the rest of it there. So again, it doesn't matter how you do it, but you can see you scale your way in, and scaling in, it's great. You only wind up with 2/3 of a position because it never really follows through and breaks out. And on the way down, you give yourself a little bit of a chance at its 23 to save itself, which just doesn't happen. So that's, the idea behind, scaling in, scaling out, and why sell stops are so important, and how that saves you from a lot of trouble. You're getting out. I didn't do the math, but I'm going to guess you're losing less than 8% total there if you're following that closely. Okay, and before we move on from this one, you'll notice it ultimately does recover. We're building a new base here. However, we don't know how this will ultimately end, and trust me, not all of them will do this. This one just so happened to ultimately recover and hold up, but there are plenty that fail and roll over and die, and these rules become infinitely more important than even here, where it just saves you, I guess, technically from not that much trouble. That there are cases where these things will roll over and wipe you out if you're not quick on the draw. So the sell stops are for a reason. You talk to any successful trader, they're going to tell you the key to their success is taking losses quick. Keep them small, keep them quick. If your edge is gone and you've got your stop losses for a reason, follow them. In the beginning, they might be a little hard to follow. The ego, the little voice in your head tells you, oh, just hold on a little bit longer, it's going to bounce. Who cares if it does? It doesn't matter. It doesn't matter if you're right or wrong. If you continue to look at these stocks, with the highest probability of working and manage your risk in a disciplined fashion, ultimately you're going to make money over time, assuming you're following your rules and discipline correctly. So here's just a list of some of the techniques or rules that we've just previously covered. Again, selling your losers quickly. I can't, rule number 1, sell your losers quickly. Rule number 2, we all know, see rule number 1. I can't stress enough. That's what's gonna keep you in the business forever. It's it's gonna allow you to make money and not destroy your psyche. That happens to a lot of people, I think, and a lot of very smart people will, they think their brains, their Harvard MBA and their CFA is all you need, and the technicals, the supply and demand, there's a lot more to it than just figuring out whether you think a company is going to make money or it's good or not. So here we're going to discuss selling proactively. Okay, so there's a couple of cases, well, a few cases where you're going to sell proactively. This is, to me, this is the one that I use the most frequently. First one is we've discussed already. I'm not going to spend too much time on it because not too many stocks end that way, is your climax top, and we don't need to get into the details of that. We have other anyway, we can discuss that another time. However, this tends to be very useful. It's based on the life cycle of a stock, the average move between each of its bases, right? So I typically give a stock on average 4 bases before, that stage 4 base becomes much more failure prone than stages 1 and 2. 3, you got to pay close attention to. I look at it that way. On average, a stock will move, your average leader is going to move 20 to 25% from one base to the next. So what you can do, right, if you want to, and the idea is as you're taking losses, you want to be taking gains to, typically I try to keep my gains to losses a 3-to-1 ratio if I can. 2-to-1 isn't terrible. So, you're obviously a part of the game, you're going to be taking small losses along the way. We're going to be wrong and forced to take losses. So, where are you selling stocks along the way to, book some gains against your losses and really keep that ratio true? I find this to be the most useful. So what I've marked here with these blue lines is 25% from the breakout. And so what you can do, I think we'd all agree that it's much easier to find 4 stocks go up, or 4 or 5 stocks to go up 20 or 25% than to buy one stock that goes up 100%, right? So you can see what I've marked here is from our first, the breakout through this high, the actual move, right, is 39% from the breakout to that high. But let's say you've created a rule. This is a powerful stock. You're selling at least half of any position you've taken from the breakout at 25%. And the point goes to, so even though it moves to a high of 39%, look where this 25% line comes. It's right in the middle of that base. Even if you sold your whole position at 25%, you could probably buy it back right around the same price. You're not going to pay up too much more for it. And you get the benefit of, there's nothing wrong with holding through this constructive action. And it's typically what I would do, but I'm simply making the point that selling proactively to keep your portfolio, risk reward in balance you're not really, your opportunity cost isn't much if you're forced to buy it back again because the stock keeps going. And I try to make, you can see this, same thing, 20. So from here, the breakout from this high to this blue line is your next 25%. Notice where that line is, more or less, right? The middle of that base. So again, whatever you sold here, you can easily buy back. So to me that, and do you do it at 20%? Do you do it at 25%? Maybe you do half at 20 and half at 25 of whatever part you wanted to, whatever feels good in your head, you can break it up however you want. The idea is to, try and keep your risk reward in line. 3-to-1 if you can. 2-to-1 isn't terrible. So this is one that I'll utilize the most, especially in a whippy stock. If I can sell it into strength at that 20 to 25% mark, take some money off the table and maybe either, move it somewhere else. And so it's an efficiency, it's effective, it's efficient, and you're managing risk at the same time. You got to book gains against those losses as you're going along. To me, this is the easiest way to do it. And if you were to play this game, I've done it on quite a few stocks. You'll see that 20 to 25%, I'm going to say more than half the time you can buy, you can get your stock back with no problem. And while it's base building, just think of all the other stocks that, the rotation is hitting that you could use that money for. So if you're a swing trader, this is an ideal way to do it. And so for me, that, this is the most effective rule. So the third way that some traders, typically more aggressive, more active, it's not one that I make use of very often, is, selling a stock once it gets a certain percentage off of, a particular shorter term moving average, whether it be, I know some people love the 8-day exponential. Some people like myself, I'm a big fan of just your 10-day simple moving average. So that's another way that you can always be, booking some profits along the way. And moving on to an example of selling into weakness. This is my goal every time. When I buy a stock, I want to get as heavy as I can at the beginning. I want to do my best to turn that 50-day simple moving average into a profitable trailing stop. Once I'm up, that's my goal. That makes life real easy, especially if it's a stock that respects its 50-day, or at least its 65 exponential, somewhere around there. Those are two good ones that you can use. It just depends, if the stock respects at 65, then I'll be using that instead of the 50 days. So it's not in stone. But you can see, how these big institutional quality liquid leaders tend to respect certain moving averages. And this one, you'll notice it time and time again throughout the length of the run. And you'll see when it's not respecting the 10, it's 10, 23, and 50-day moving averages, as it does all the way through here. We get a tiny shake below its 65-day exponential, not enough to kick you out of the stock. And so if you're patient and let the stock tell you when to sell, instead of getting nervous every time it runs up and wondering, is it done? Just wait for the stock to, and you can see you never break by the time this thing closes below its 65-day moving average on big volume here, and look at all the volume that picks up too. There's no reason, you don't need to scale out or even give it another day to see if it recovers. I mean, if you did want to sell a half of it, and this is another way, if you wanted to give it a day to recover and see, you can sell half your position, and then on an intraday basis, you can bail out of the rest of the stock below the low of that first close below, if you wanted to give it that. But anyway, that is how I like it to let a stock force me out and ultimately sell into its final bout of weakness. But that obvious weakness, that big volume break of a moving average that it didn't break from the mid 40s to over 200. So that makes life very easy. There's no guessing. You just wait. It breaks the line. You sell. Done. And you make plenty. You're never getting in at the bottom and getting out at the top. You just need to get a bulk of the move in between, and you can't complain. So as a final example, we've got Tesla's daily chart here showing its move from the time it broke out in April of 2020 up until the end of the year. We're not going to spend too much time covering all of this action. Early up the right side, we got pretty in depth there. On NIO's chart, you can go ahead and take a look at that on your own. There's nothing new under the sun there. Again, we continue to base build, and it's the same game over and over again as you're managing risk. The most important thing is that you're watching your average price and managing your risk on the way up. The big picture, again, that I'm going to point out here on these high quality, institutional quality leading stocks, Tesla was one of the top leaders of 2020, if not the leader of 2020. And notice throughout the length of the entire run, it gives its 23-day moving average respect. And then ultimately, once we get a little later in the move, it comes down to its 50 and 65 day, but you get a clear respect for these moving averages. And obviously we know in 2021, Tesla ultimately rolled over, broke its 65-day moving average. And that's where I was pushed out of the stock. My final shares were pushed out there. And again, that's how 9.9 out of 10 of my trades end in that way. I don't like having to guess. And I'll be honest with you, when I do try selling climax moves, I'm usually a day or two on the early side anyway. And I find that just having one clear, simple rule to follow over and over again over time, it's perfect. You're again, you've got to remember, you're not going to get the ultimate low or the ultimate high of it, on any move. You just need to get a good chunk in between. So it helps preserve that emotional mental struggle you'll go through as you're watching a stock run up and run up and run up. Is this the end of the move? Don't worry about it. Just let it tell you when it's done. You'll make plenty. So that being said, I'm happy to answer any questions.